So, should you sell weekly options? Another good question for our group. So, welcome back, options traders. And during mid-June of 2022, when we are experiencing at least somewhat higher volatility, I still wouldn't call it outrageously high, but certainly enough to where we are hearing about a lot of traders trying to sell options, whether calls or puts. And yes, during higher volatility, that is certainly a sound strategy. You should probably lean in that direction. But which expiration? Should you sell the weeklies? So let's go have a deeper dive and find out, should you sell weekly options? And as always, before we get started, please click like and subscribe. It definitely is very much appreciated and is doing a lot to promote the channel. So once again, the basis for this idea that traders should sell weekly options is this square root pricing rule. And which we've mentioned this in many previous videos, but as a recap, it takes about 4 times the amount of time to double an option's price. Now this applies only to the at-the-money options. And so because of this, longer dated options become actually cheaper to buy per unit of time. It's like buying things in bulk. And that means they become a progressively worse deal for option sellers. So again, traders think, oh, I should therefore only sell weeklies. Well, possibly, all things being equal, yes, traders should prefer to sell shorter dated options. But this also leads them to believe that they should only sell weeklies. And this is where the fallacy and the dangers lie, because this is definitely not true. So how can you figure out which expiration to write? Well, if you are writing calls or puts, there are really 3 different calculations that you should do. But it's a little easier to see and understand if we look at it in terms of a covered call. So let's say that you have shares of stock or possibly another option, and you wish to write options to collect these premiums. So here are the 3 calcs. The first one is called the static return. The second is the return if exercised. And the third is called the break-even return. And what you want to do is to be sure that all 3 calculations make financial sense before writing the option. Now, what does it mean to make financial sense? Well, there's not really hard and fast rules that you can attach. A lot of it just depends on what your goals are, risk tolerances, and really what you're looking for. But there will be some cases that are glaringly obvious that they're just not a good option to write. And yet that's what I'm hearing about lots of traders writing. So let's go take a look at an example in the Thinkorswim platform. So now in the Thinkorswim platform, I'm just going to use Microsoft, and we can see that the stock closed at 247.65. So let's say that we decide to write the 250 call, and we have 6 days until expiration. Now the markets are closed right now, and I did this intentionally so that the numbers aren't flickering around. It'd be a lot easier to see and get locked onto prices. So we wish to write the 250 call, and the bid is $3.30. Now also, before we do this, take note of this number up here. Based on this volatility of 39%, just a touch over 39%, they're showing plus or minus 9.78, or let's call it about $9.80. This is a 1 standard deviation move of what's expected during the life of this option. So think about that. That's roughly $10, plus or minus $10 over the next 6 days, and that's just 1 standard deviation. 2 standard deviations would be $20. So that's a good reference point to kind of set the stage to figure out how much of a price we need to make some of these calculations work and actually become financially a good deal. So those are the numbers we're going to be using. Now let's go see how we use them. All right, so first up is the static return. Now static return, as the name implies, assumes that the stock price has gone nowhere. That doesn't mean that it can't move between today and expiration. It just means that whatever the price was for the stock the day you wrote the option is also the price that you get at expiration. So we had the 250 call trading for 330. Let's assume that that's the price that we received. So to find the static return, we're going to take this 330 price and divide it by the current stock price of 247.65. And that comes up to 0.013, or about 1.3%. So remember, this is for a week. So if we want to scale that out for a month, we would multiply by 4, and that's going to give us about 5.3% per month. Well, that's a pretty healthy return. Remember, that's going to annualize out to over 60% per year, and a lot of stocks don't move 10% in a year. So premiums like this are hard to pass on. So this already is looking fairly good. Now there's another calculation that's probably a little more financially correct. This is the one that I usually use. It's just that it involves a couple extra steps. And what you're going to do is to take the 247.65 stock price and subtract off the 330 price that we received up here. So that gives us an effective stock price, or our cost, of 244.35. And so if the stock is 247.65 at expiration, you can think of it as though we bought the stock at 244.35 and it grew to its current price of 247.65, and that comes up to be about 1.35% per week instead of 1.3. So also remember, as I've talked about before, the price you should be using for your calculations is the current stock price. Doesn't matter if we paid $100 or $200 for this stock. The amount that you are putting up at risk is the current stock price. So always make your calculations based on the current stock price. That also makes it easier too, because now you don't have to go back and look up your cost basis and keep track of things. Just use the current stock price. So this is one number that we're going to use as a reference point, that we've picked up about 1.3, maybe 1.35% for a week. So that's the static return. What about the return if exercised? Now this one too, as the name implies, assumes that the stock price has risen past that strike and that we get assigned, or in other words, that the person who bought the call exercises it. So let's go back to our data here. We had a 250 call sold for 330, and we could say the current stock price 247.65 minus this price again gives us an effective cost of 244.35. Now, if assigned, we are going to receive the 250 strike. We sold the 250 call. No matter how high that stock price rises above there, that's the most we're going to get. So now just think about it logically. If you paid 244.35 and end up selling for 250, what's the percent return? Well, an easy way to do it is to take the closing price, 250, divided by the starting price, 244.35, and that gives us about 1.023, or about 2.3%. So now you can see we've gotten a little bit more of a boost, because we're also getting some capital gains if the stock price rises above this 250 strike. Now again, this is for a week. So that's going to work out to be about 9.25% per month. Again, extremely good returns. Now, something else you should check, and this is where a lot of traders make mistakes, and the thing that we want to answer is how much of a gain is from the stock price. So in other words, we have the stock at the current price of 247.65 and it rises to 250. That is strictly from the price of the stock alone. It has nothing to do with options. Well, let's go check that. So we would have a 250 stock price divided by the current price of 247.65. That comes up to a ratio of about 1.0095, or about 0.95%, just under 1%. And so what this means is that, yes, we are getting potentially 2.3% from this strategy, but almost 1% of that is just coming from stock price movement alone. But still, that's more than double. So that certainly looks good. And again, that's a judgment call, but I would certainly think that's an acceptable ratio. The thing that you have to watch for is you might see where 99% of the valuation is coming from the movement in stock, and you're only getting pennies from the option. Well, that's not even worth selling the option for. So that's why we would do this little check as well. And then finally, let's take a look at the break-even return. Now, it's called the break-even return. It's more of a break-even percent, or a break-even level. So again, we have the 250 call where we received 330. Let's say the current stock price is 247.65. Subtract off the 330. Again, it gives us an effective cost of 244.35. So what we're saying here is, what if the stock falls from its current price of 247.65 down to 244.35? we would just break even. And what is that percentage? 1.3%. So now we know that the stock can fall 1.3% and we'll just break even. So it's giving us a nice little bit of a downside hedge. And what you need to do as a trader is to figure out a good blend. What's a good static return, return if exercised, and a good break-even return. Now also keep in mind, when we were looking at the quotes, I told you to remember that number that Thinkorswim was showing us in the upper right-hand corner. And it said that Microsoft's implied volatility was about 39.06%. And that implied plus or minus $9.79 by expiration, but that's a 1 standard deviation move. So that's roughly a 4% move just for 6 days. Again, that's 1 standard deviation. So recall that 1 standard deviation would occur about 68% of the times. But if you want to consider 2 standard deviations, we're talking about roughly 8% movement, plus or minus, for 6 days. So yes, we are getting a 1.3% downside hedge, but we also shouldn't be too surprised if it falls 4% or possibly as much as 8%. And so that's going to give you a pretty good backdrop to see the potential volatility and to say, is this an acceptable downside hedge? And if the answer is no, or if any one of these calculations breaks down, then go out to 2 weeks or 3 weeks. Make sure that all of these calculations make sense. And so even though you might be writing a 30-day option and not truly maximizing the revenue per unit of time, that's not really the issue. The issue is, are you making the sale worthwhile? And to do that, we need to check these calculations. Now, if you understand these for a covered call, or even if you're writing it against another option, they are very similar for using puts, and you should be able to get the gist of it. But make sure you are at least getting a good return. The return for a put should be the amount you're receiving relative to the margin requirement, and then you can also check for the break-even percent. But those are the areas that I find that most traders that I've been speaking to start to really make some bad mistakes. I see people writing options on $300 and $400 stocks for something that's so far out of the money and they're getting 10 or 15 cents. And it just makes absolutely no sense. You're just sealing off the upside for no benefit. So while we're in these volatile times, and if you are one of the many traders who are deciding to write options, hopefully this will give you some better things to think about. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.